Hello, everyone. This is Sebastian McMahon from IA Financial Group. As you can see, I'm on the road. The quality is not top notch right now on this video, I'm sure, but I wanted to make sure that I don't miss such an important week in the markets. So here I am covering the week ending February 3rd, 2023. So let's start, as usual, with a look at this week's markets at the close on Thursday. So positive week for bonds. So after 2 difficult years, we're having a great start to 2023. Good news. Equities, the rally continues. We still think it's not based on strong foundations. So we always encourage that taking some profits or staying the course. This is what we're doing with our strategy. We remain rather defensive, although we have warmed up to a few regions around the world, but especially the rally on the Nasdaq, almost 17% year to date. That's on shaky foundations. When we look at what performed since the beginning of the year, we see that the most shorted stocks have performed very well. We see that the meme stocks are back at it. So Bed Bath and Beyond, AMC, GameStop. So these stocks are a bit again, and being on the road quite a bit, I'm starting to get questions again about cryptos, NFTs, the most speculative asset classes. So for us, that leads us to remain rather defensive in our positioning. But again, the markets are the markets, and we may always be wrong here. But again, it's your money, so make sure that you avoid the typical cognitive biases, just like the bandwagon effect and stuff like that. So just a message here for other markets, price of oil lower by 5%, Canadian dollar lower, euro higher, gold lower. So lots of action this week. Maybe just a message also, it's very early in the morning. While I'm recording this, the jobs data in the US have not been published yet. So if there's a big surprise today, it's not what I expect, but if there's a big surprise and the markets are moving quite a bit, well, that explains why I won't be mentioning it in the analysis in this review. But I'll be talking about the Fed. That was the story on the week. And as you can see here, a 25 basis points hike. And we're not done yet in the US. The Bank of Canada did announce its colors that they are expecting to stay on hold to see the impact of the cumulative hikes, but they might always hike if something happens, like for example, if the jobs reports continue to be very, very strong for a few months. Still, the Bank of Canada could still do one turn of the screwdriver, but in the US they're not done. We're at 475 in the US. The Federal Reserve was pointing towards a terminal rate around 5.1%. So maybe there's one, maybe there's two hikes coming by the end of the year. But here's where we are. But Mr. Powell, the message was pretty clear that it's premature to declare victory against inflation. So that's what we have here. And on the right, this is from CNBC, but Mr. Powell did say that that you should not expect a cut in 2023. So when you fight inflation, you fight it till the end, and the fight against inflation won't be won't be won in 2023. Inflation going all the way from 6, 7, 8% to 3.5%. I mean, that's the easy part because of the base effects, but after that, there might be some inflationary pressures that linger, and that might force the hand of the Fed to stay the course for even longer and keep rates higher. Now the markets are not listening to that message, and that's what we noticed this week again, because Mr. Powell did say these things. Maybe he didn't insist correctly when he was passing the message, but as you can see in this chart here, these two charts here, on the left, you see that rates have been going up, but the gray part are what's priced into the markets right now. And yes, one or two hikes still. After that, the Fed cutting very swiftly in H2 2023, so the second half of the year, and that flies completely in the face of the Fed's message. So will the market, bend to political pressure or to the market's pressure? It's always possible because you can see on the right, it's a 50 basis points of cuts that are priced in into the market. So if it doesn't happen, that would be a surprise to the market, and the market would have to adjust to this information, and that could cause volatility. So there's still this risk that's lingering in the background in the markets, and that leads us to remain careful before calling an end to this bear market. So again, we don't have a crystal ball, but this is the strategy that we implement in the diversified funds and the managed solutions here at IA Financial Group. So some history, maybe just to give some more background. Here you have all of the Fed rate hikes since World War II, and inflation at the start of the cycle on the bottom, and on the vertical axis is the tightening after 1 year. So on the top right you have the early 1980s. So that was an even steeper tightening of the monetary policy that we saw then versus 2022. But look at how 2022, I mean, it was serious. Inflation was high. They had to hike by quite a bit. So, that was quite a tightening cycle. So this might be behind us, or most of that behind us, when they do one or two more hikes. But after that, it's not because you've hiked that much that you have to start cutting early. You need to make sure that you get all of the benefits from that. And the benefits are that you fight inflation till the end. So there's still some risks in the market, and the market is maybe not listening to the Fed's message here. So an optimistic market reaction. So on the left here, you have the 2-year rate. So you see the latest jobs report. I mean, the rates started falling, and now with the Fed's message, down again. So the market is expecting those rate cuts. That's what's priced into those 2-year rates. And on the right, that's the S&P 500. Reaction was again positive. It is even more so on the Nasdaq when the Fed delivered its message on Wednesday. So this is the setup that we have in the markets right now. So again, what to watch next week? The jobs report in Canada, 104,000 jobs in December. That was very strong. Let's see if we have a slowdown of the pace. Long-term average is nearer to 10,000 than 100,000. So let's see if we lose that pace. And again, if there's one thing that could push the Bank of Canada into hiking again, is if the labor market remains that strong. So that it's becoming a very important indicator in Canada. And the unemployment rate last month was at 5% in the U.S. Trade balance, University of Michigan sentiment index. So a more quiet week in the U.S. So that wraps it up for the week. ia.ca/economy. You can always subscribe to the newsletter, podcast in your interest. There's always a new episode every single week. Economy, finance, so 101, some new material is coming. And social media, Twitter, LinkedIn, you can always find us there. So thanks for following us on a weekly basis, and I'll be back again next week.